everybody. My name is John Novak with Nexgen Software. We're going to spend the next few minutes going through reading our Fibonacci support and resistance areas and getting the reads of our trigger lines to determine where we should enter and whether or not support or resistance is going to hold. Just a short disclaimer. Take a moment to read that. Now let's talk about making money 101. Pretty simple. Define incredibly high probability setups, something that gives us greater than a 70% chance of winning. We're also going to risk the least amount possible on every trade by getting proper entries. We're also going to be able to read our software effectively so we're able to take as much profit as the market gives us on every trade. In essence, we're going to learn to buy low, sell high. Now, let's not forget Fibonacci support and resistance, which you can see across our chart, right? Red lines of resistance, blue lines of support are going to be the mainstay for what we're looking at. So when we look at support and resistance areas, we're going to look at a couple different factors for determining whether they're going to hold or break. And we're going to use our trigger lines for this. And trigger lines are pretty simple. It's a linear regression calculation. And a linear regression line basically tries to draw a straight line between 2 points that don't make, or multiple points that don't make a straight line. And again, we're going to use this for determining whether or not our Fibonacci areas hold or break. Now this is from the trading plan that you will have on your desktop when you complete the installation of our software. And we'll go through these real quick, but I think it's easier to have the visuals of these instead of the text versions. So when you get time, read through the trading plan and go through these 11 items. Really covers everything that you need to know rule-wise for the trigger lines. And what I want to do in the video, instead of reading these to you, is actually show you. So let's take a look at our trigger lines. Again, there's two pieces that make up a trigger line. Right? We have our linear regression line, which is always the fastest or the lowest line when they're going down, or the fastest line when they're going up. And we have an average, a moving average of that linear regression line. And essentially this gives us the ability to see whether they're crossed up or crossed down, helping us to identify direction. Now, when we look at our trigger lines, right, on a big scale, we're looking at a couple things, right? We've got our bars, data bars that are in there, and this is our Nexgen dynamic Renko bar. And I want to go through a couple of the basics with you so you'll have a real good understanding, right? When our trigger lines cross down, right, crossed up and then crossed down, usually when you get a first pullback to a newly crossed trigger line, or you get retracements in price with the small triggers or trigger lines crossed wide to the downside, you can expect more down. As the bars themselves and the bodies of the bars start to get on the opposite side of the synthetic triggers, it shows a weakening of momentum or a loss of momentum. And then ultimately you can see the market or the price bar itself closed up and the trigger lines crossed over, and we get kind of repeat process in the opposite direction. We pull back to trigger lines that are crossed up, and we start to have more probability of going to the upside. And then eventually you can see they cross down and the market price pulls back to newly crossed down triggers. And then the market pulls back to small trigger lines that are crossed to the downside. And basically we repeat this process over and over, where it gets above, gets below, crosses up, crosses down. But you'll see, when you have, let's just say, an extended run down to the bottom, as these small trigger lines cross up and they start to widen, you can really see the potential for reversals. So just some simple basics for reading the small trigger lines, right? If your price bars are completely below them, there's a lot of momentum to the downside. As the price bars get inside or above, even though they're crossed down, right, you're showing a loss of momentum. So if you're reaching a target area as you look at this configuration, usually a pretty good idea to take your profit at a target area. One other simple concept that we teach on a regular basis is if our trigger lines, and we're going to assume that this red line is a Fibonacci resistance line, if our trigger lines physically break through a resistance area, we're going to anticipate that the market is going to keep going. So we're going to anticipate that our resistance is not going to hold. Only if the triggers roll at or below a Fibonacci area of resistance are we going to anticipate that area to hold. So now the next slide, this is one that I use in class. I mean, I made it back in a year ago. And I use this slide every day in our class, and it's a real good example of what our trigger lines look like. So these are small trigger lines on a single Fibonacci area, just kind of keeping it simple. But you'll notice over here, right, I've got number 3 on here twice, and we'll explain that in a minute. But you'll notice we have blue Fibonacci support, and the trigger lines don't break through that area. And you'll notice that the price stopped out the prior price low, but the trigger lines still didn't break. This is one of our very powerful pivot stop outs at Fibonacci support that we use for a counter trend trade. Now, as the small triggers in price reach Fibonacci resistance, you'll notice they're very strong to the upside and they physically get above the resistance, which tells us that we have to wait for either a breakout, or if the trigger lines get back below the resistance, then we can use the resistance for short trades. And then when we reach Fibonacci support again, and again, you see I put number 3 on here twice. The first time they didn't break through, and they rolled up, and the second time we actually broke through that price area. So when we see this really strong trigger line into a Fibonacci area, there's a potential to break. And you'll see indeed we do break down below, and we pull back to retest this resistance. So it was support, it becomes resistance, and resistance should hold because our trigger lines are below resistance, which will give us another short trade opportunity, right, after support breaks, to take it down to the next support. And you'll see that when we get to the next support area here, our small triggers are below the blue line. That's bad. We're not going to be going long. Good place to take a profit if you're short, but because they can never get back above the blue line, it's going to break. And it does break and turns into resistance where we can continue taking short trades with a trend. One of the other trigger lines that you're going to see on your charts is what we call a synthetic trigger. And all it is the trigger line value from a larger chart superimposed on a smaller chart. So you'll see on the right side, this is our small trigger lines from an 8-2 chart, an 8 body size Renko bar chart. And you'll see that the same line value is superimposed on a much smaller 5-1 chart. So what we're going to use this for is to be able to see some of the trigger lines from larger charts superimposed on a smaller chart. So when you get to your charts, and this is the way we run our chart in our trading room, in the educational room, we've actually got 3 sets of trigger lines on your chart. The first one that you see in yellow is our regular small trigger line, and that's from the chart that you're running. And then we have a superimposed 8-2 synthetic trigger. And then we also have a 14-2 synthetic trigger superimposed. And you'll see, and we're going to go through a lot of examples of trigger line reading where we're able to read the multiple time frames of trigger lines. And then we're going to incorporate our Fibonacci areas to give you some very high probability trade setups. Now, before I get into the trigger lines themselves, I want to digress for just a second, and I want to give you a visual of our new T3 market flow indicator. And this indicator I've got a couple of terminologies on my trigger line charts that I want you to understand. So HVA is a high volume area. So this indicator will basically has two plots. Green or magenta plots telling us that the buyers are in control of the bar or the sellers are in control of the bar. And then these HVA areas are high volume areas. You can see these wide black ticks. This is the price at which more volume happened inside the bar. So when we look at our trigger lines, I'm going to say this is a trigger line look that's favorable. We should be looking for a high HVA area for an entry. So I wanted to give you a little bit of terminology before we got into our charts. And I'll show you what it looks like on a couple examples here. So here you can see we made a bottom and the market pulled back to the high volume area. Okay, and when the high volume area is in the middle or the lower end of the bar, that's the entry location that we're going to be looking for. So if we were looking for a long trade here and the market was trading up, we would want the market to trade back to that high volume area so we could get long. Now, if the high volume area is at the very top of the bar, right, instead of focusing on just that high volume area, we're also going to look at where the majority of the green dots came from. Because typically, if it's at the top of the bar, the market will come back to the dots area. So then that just really makes the dots your high volume area. So I just wanted to, give you guys some terminology. So when we look at our trigger line charts, you're saying, okay, we're looking for a long. I should have a high volume area, that we're looking for an entry. That's what we're talking about, is this high volume area. Now, there's a couple other reads that we're going to use with our trigger lines, and terminology-wise, you're going to have to understand, right? So this blue line represents Fibonacci support. And you can see that using our market flow indicator, we have multiple magenta dots as we break Fibonacci support. This is going to create not only a high volume area, but also an entry area for us at our Fibonacci resistance when we're looking for short trades. Right? So when we're looking at prior HVAs, high volume areas, this is what we're talking about on our trigger line read. And we can also, we'll see it at tops and we'll see it at bottoms. And we're going to use one more terminology that I'll show you here on this slide. It's what we call a high volume area at a Fibonacci with a tiny reversal bar. And this is a different style of chart than our Renko bars. We're going to go, not only look at our areas with our bars, but we're also going to look at fine-tuning entries. So I'm giving away a little bit, obviously, before you get to that video, but I just want you to see tiny reversal bar. That's what it looks like from an area. So now as we get into our trigger line reads, we'll skip that slide. We don't need it. Okay, so let's go through the trigger line reads that are going to make things very, very simple for you. Right? In this example, you see very strong small triggers to the upside and synthetic triggers to the upside. Don't think about any shorts whatsoever until your small triggers get below your synthetic triggers. Right? Now, as the market's coming down, if you're in a short position, right, recognize if you make a double bottom or close to it, if your small triggers are considerably higher than they were when you made the first low, right, this is generally after a strong run up where this higher small trigger line, and usually it's from an area, mid-band, or a 165 EMA, where the market will come back up to retest the synthetic triggers that are rolled over, and now we have some shorts that are going to be much easier for us. So if for some reason you're in this short position and you see this trigger line configuration, That'll be an exit for you, and look for shorts from higher areas. You'll see this same pattern happen a lot, right? And it happens a lot at multiple time frame support. A stop run of a low, but as you make your reversal bar, your small triggers are much higher than they were the last time, and you're closing above all of your synthetic triggers. This is a high probability look for a bottom. All right, so we'll use that same look up here at the top. We've got a stop run of the highs, and we've got lower small trigger lines that are below our synthetic triggers. Right? This is a spot where if we have a tiny reversal bar to fib or other high volume reasons for a short, we're going to want to take a short trade. Now, as we're in our short and the market's progressing down, look at this green arrow. This huge gap between price and our small triggers, which are rolling over, is usually going to get closed. Remember what we talked about with our small triggers rolling over and pulling back to them when they're crossed to the upside? This is that look that if you were short, you would be out of your short position. Or if you had Fibonacci reasons in a high volume area, I'm just going to say HVA from now on. Right? If you had an HVA here, you could actually take a long trade to get back to your synthetic triggers. And you're going to see some of the more experienced traders doing this on a regular basis. And now you really understand why, with this huge gap, wide small triggers, and a high volume area here, you're going to be able to take a long trade in this situation. One of the other patterns that you're going to see is the small triggers start out below your synthetic triggers. And they push up, and you're thinking, all right, we're going to keep going up forever, and eventually the small triggers will roll over. And this is another situation where we've got very wide small triggers to the downside, right? And if you've got your high volume area here, and especially obviously if you're coming from Fibonacci areas, this is going to be a trigger line look that you're going to want to take an entry on. Very strong, wide, small triggers to the downside give you a best look for selling a high volume area. Now you see the same pattern, or different pattern really, but the market pulls back to wide synthetic triggers to the upside. Remember when we said, pulling back to a trigger line that's crossed to the upside gives us the potential for a bounce? Well, this is what it looks like when the market pulls back to a higher time frame trigger line that's crossed up. And we get a bounce, right? And you may or may not have a reason for a trade here yet. But after the bounce up and the small triggers roll up, if you have a high volume area here, right, that started at the bottom, this higher small trigger line look at the time you reach the high volume area is a very, very, very good look for a long trade. Right? And then as that progresses, you can see what happens again. As our small triggers start to roll over, we have synthetic triggers that are far away. Right? So again, if there's a reason, Fibonacci reason, in an HVA area here, you can take a long trade getting back to those synthetic triggers that are far away. Same thing here. Remember we talked about checking for past breakout areas. So if we were breaking Fibonacci support and pulling back to synthetic triggers that are wide to the downside and a past high volume area, we've got a really good trigger line look for a short trade. Now I want you to also see this. Remember, the talk of small triggers crossing strong to the upside, right? If we've got a high volume area breakout to the upside and support, right, this is going to be a look that you can still take a long trade from, especially from Fibonacci support. So again, small triggers very wide to the upside, the probability from a high volume area is that the market's going to go up. And again, another example of strong move to the upside. Even though the market comes down, we've got a very large distance back to your synthetic triggers, right? Doesn't mean that they can't keep going down, but many times in a strong trend, you'll hit support, and we'll be able to use that support to look for a trade. But this trigger line look is something that you need to recognize. And you'll see the same trigger line look again. Strong move, wide gap back to maybe Fibonacci resistance. More potential to get back to the trigger lines. Now, in our educational room, we're going to talk a lot about trouble spots. Right? Trouble spots are when you go short above your synthetic trigger lines and the market makes it back to them and can't penetrate back below them. That's an exit spot for us if we were short from up here. All right, again, couple things to look at on this slide. When you get, remember we talked about, right, price bars on the bigger chart getting above your trigger lines. Well, how that's represented with synthetic triggers is a very tight compression where everything squeezes together really tight, and then we get a breakout to the upside. And not only that, we get our small triggers rolling up strong. This is a look with a tight compression and strong small triggers to the upside that we're going to be looking for high volume area pullbacks for long trades. Then as the market progresses up, you'll see our small trigger divergence here, right? This is where maybe our fib to fib oscillator has divergence potential, but you can really see the new high price, lower triggers. That's a look where you're going to want to exit your long trades, right? Then you're also going to see, right, the edges of your synthetic triggers. Right? So even though the market made a lower low, we're still inside and small triggers are still above the bottom of our synthetic triggers. And again, you guys are going to hear the term a lot. Pivot stop out at Fibonacci support, and we take long trades. Here's another example of the same thing. Right? We've got very strong down synthetic triggers, right? And we get a pivot stop out, right? Usually this is at a mid band or a Fibonacci area, and these pivot stop outs are where we're watching for tiny reversal bars with high volume area entries when our synthetic triggers are still down and well below us. Another example of, again, trigger line compression with small triggers rolling over very strong to the downside. This is a high volume area short look. But you also have to recognize as it progresses down that we've got a very large gap to get back to the synthetic triggers, which causes trouble. And then you can see eventually, right, we try to break through and can't do it. And eventually we have the small trigger down strong look back below our synthetic triggers. This is a look where we want to take another short trade. So sometimes they'll get close to resistance and you'll get a little short, recognizing you need to get out because there's a big gap back up. And then sometimes you get that, second chance at a short trade from, the end of your Fibonacci resistance window. But again, just pay attention to these very strong small triggers below your synthetics and looking for these high volume areas for entries. Now, I want you to recognize also, right, higher small triggers with our synthetic triggers still up and the market goes up, right? And we get a pivot stop out and maybe a potential reversal bar to the downside. When we pull back up for the retracement, notice how much lower the triggers are here than they were the first time. Right? So this is where if you were short, you'd still maintain your short. Now, as the gap gets really large and our synthetic triggers haven't come down, I want you to recognize one more time a pullback to very wide small triggers to the upside with this big gap back up to synthetic triggers. Very good look for a counter trend trade long if you have the right areas and opportunity. Now, let's start to incorporate some of our Fibonacci work. Remember that first picture that I've been using for the last year every day in class? Strong small triggers up into the Fibonacci resistance. Notice how they roll back down below Fibonacci resistance, right? As they're rolling down, you're looking for the high volume area entry for your short trade at resistance with a large gap to get back to your synthetic triggers. See how we're starting to put together three of the pieces: trigger lines, high volume areas for entries after the trigger lines roll, and the large gap back to our synthetic triggers. Let's take a look at another one. This one has a few pieces to it. We hit resistance and the market runs down. But we recognize there's a large gap, so we might run back up. Notice the pullback to your small triggers going straight up. If you were short, this would be a warning sign. Right? Then we get a pivot stop out at Fibonacci resistance. We love that look for a short. Right? Maybe it happens really fast. You don't get a tiny reversal bar there. If you do, obviously you're short. If you've got a high volume area that falls into this spot and you didn't get in, then you get another opportunity for a short trade, and you can recognize how much lower your small triggers are at the same time. Now watch what happens. The market sells off. You're thinking, all right, I'm going to make another 100 ticks. We pull back to our triggers and it starts to go down. This is where, let's just say we have a high volume area after a sharp, strong run of buyers. When we retest this area, maybe you have divergence potential on your Fib to Fib oscillator in another video, of course, or you have Fibonacci support. You recognize that your small triggers are much higher and that the market may go back up. Now, it does go back up, obviously. Now, I want you to notice, not only over here on the left did we have lower small triggers, and at the bottom we had higher small triggers. I want you to notice on this stop run at Fibonacci resistance, this big yellow arrow. You know, not only do we get that trigger line look on little small triggers, we also get it on our synthetic triggers. So notice the location of your synthetic triggers well below this Fibonacci resistance. A big gap to get back to them, represented by this green arrow, and the small triggers didn't break through Fibonacci resistance. So, you know, when you add up lower synthetic triggers far away from resistance with a big gap and a pivot stop out at Fibonacci resistance and the small triggers not breaking through Fibonacci resistance, this is basically the trifecta for trigger line reading and a counter trend trade short from our Fibonacci area, which really takes off with a lot of strength to the downside. This is where we're looking for that tiny reversal bar, any type of selling momentum to get us into a position to take that short trade. All right, now bringing in all of the pieces that you're going to see when you get into our educational room. Right? So, you know, again, when you just look at this picture without some of that background information, right, it becomes a little daunting. You're like, oh my goodness, what's going on here? Right? But let's just break it down slowly. Notice we have a divergence plot from our Fib to Fib oscillator. Right? Please take the time to review that, because it's very imperative that you understand when the potential for divergence is there, right? So you can either exit your longs or look to take short trades. At the same time, look at the black arrow. Lower small triggers as we make this divergence tells us don't hang on for dear life. Think about getting out of your long trade if you're long. Right? If there was Fibonacci reasons, we'd take this look for a short trade at a pullback to our small triggers and high volume area, which you may do anyway, which would be the short trade to get back to Fibonacci support. Now, as we reach this Fibonacci support, remember when we said if our small triggers are very, very strong down, you have to wait? Well, this is that situation. Yes, we anticipate the market's going to go up because look at this large gap and this green arrow that we have to our synthetic triggers. Remember we said if the small triggers are rolling up strong, we have more chance of a long trade. This is where we start looking at our Fibonacci support during this pullback as the small triggers are higher. See that higher small trigger look? You're going to get used to seeing that now. If we have a high volume area here, we're looking to take a long trade. If for some reason you missed it, right, and the small triggers broke through, you may get a second opportunity of another high volume area here, right, with even a more favorable look for going up. So you start to build a story, right? Big gap in our synthetic triggers, small triggers rolling up, high volume areas helping the support with higher small triggers for long trades from this area, right? And I mean, this right here was a 50 tick trade to the upside up to resistance. Then we get to resistance and none of our triggers broke through. So we're looking for this down bar maybe and then a pullback to sell a high volume area at our fibs to get short. So there's a lot going on this chart, but this is what it looks like during the day in the real world for us. That's why I wanted to kind of slowly build the pieces. So again, lower triggers, divergence, we're going short, or at least getting back to support. Getting to support, the small trigger read says hang tight. It's coming down strong. Then we start to build reasons for easier long trades as the trigger lines roll up. Let's take a look at another example. Again, very strong push into Fibonacci resistance, right? But none of the trigger lines broke through our resistance area here. This is where we sell high volume areas, right? And they may even come back and retest that high volume area again. As long as they go down from that area, that's okay, right? And then we trade back into our synthetic triggers, which were very far away. See the big green arrow, right? This big gap back to the other synthetic triggers gives this resistance up here much more power. So when we look at the resistance, even though the small triggers are strong, when they start to roll over below the resistance, we're looking for that HVA for a short. We get to the trouble spot, and obviously it bounces, and again, retest of our Fibonacci area, no triggers break through. Then you can see we come down. This is one of our favorites for counter trend trade longs. Pivot stop run at Fibonacci support. This is where we get that tiny little reversal bar for a trade back up. Granted, it didn't go very far, but this is what we're looking for when we're reading our trigger lines. Let's take a look at another one. This is an example of a strong push of our small triggers below Fibonacci supports. This is where we look back in time on our tick chart or volume chart. Where was that prior high volume area? Is it in line with the area that we're looking to sell to take a short trade? If it is, we want to be more aggressive in getting in at that area. That's how we use the prior high volume area with a trigger line read that says we should keep going down. Then we make it down to support. And again, another good example of, right, a strong small trigger into support. We get a good push up, right? If you don't get that push up, that's okay. When it comes back down to a high volume area with your higher small triggers above the support line, you're going to be looking for your first counter trend trade long. Right now, granted, we ended up stopping at the mid band, right? But look what happens. They come down, a pivot stop run at support, right? You're not getting long right here. Maybe you are if you have a tiny reversal bar, but more importantly, if they make the up bar, now you're going to be looking for high volume areas to take advantage of that pivot stop run. Even if you don't get it from the bottom, you look for it here as a second chance opportunity. High volume area at support, low risk trade. All right, so taking a look at this one, pretty easy read, right? The market comes down. We're looking at prior high volume areas to be aggressive with our entry price. Okay, now, obviously we want it to go down 100 ticks, or however many ticks that is, to support. But when we make new lows, we're like, uh-oh, we have divergence potential in our fib to fib. And we also have higher small trigger lines that could cause trouble, right? We don't want to give back all of our profit. We want to make sure we're maintaining or watching our position for an exit. Then one of our favorites, a pivot stop run, still expecting more down because all of our trigger lines are below resistance. This is where we start looking for that tiny reversal bar or another high volume entry area to finally get the short after they stopped everybody out. And again, when we get to the bottom of our Fibonacci area, we're not looking for longs because our synthetic triggers are pushing hard through our Fibonacci areas. All right, another real good example of a little bit of a chop and then a breakout to the downside. Right, so we're looking back. Where was our prior high volume areas as we broke out at that Fibonacci resistance area? Maybe we have one. If not, tiny reversal bars right at our Fibonacci areas with the high volume area right at the Fibonacci area for our short trade. This is a perfect spot with all of our trigger lines below Fibonacci resistance to look for that tiny reversal bar or a high volume area short. Again, another example, very, very similar. Breakout of support, quick pullback right to the area. You're going to have confidence getting in at that spot when you've got your prior high volume area at that spot. And then we had divergence at the bottom. We didn't have any trigger lines helping us out, giving us a heads up that that divergence was going to hold. So it doesn't always happen with divergence, but it happens. When it does happen, you really need to pay attention to it. All right, again, same thing. Break out of an area. Huge gap back to our synthetic triggers that are way down there below us. We're looking for the tiny reversal bar on our other chart to time our entry very quickly, or a pullback to a high volume area for our short trade. All right, we're going to go through this again. These are very realistic, real world charts from not too long ago. Notice small triggers are going up strong. This Fibonacci support and our synthetic trigger line with our synthetic triggers above us, right? We're not getting in maybe the first time over here, maybe we are, but we're looking for this high volume area in here with lots of green dots and lots of buyers to really help us fine tune this look for continuation to the upside. Now, we get to resistance and the triggers are strong. Just barely get to this one, and again, it's not the best look for easy short trades. All right, look what happens. We bounce around. We're kind of stuck in between areas. When we're stuck in between areas, look for the pivot stop outs at multiple time frame support. Right? Even though we're range bound, this is where your tiny reversal bar with all the volume right at 49.96 is going to give you a long trade at, maybe 98 and allow you to trade in between this range. Recognize the pivot stop out again with your triggers below. Maybe a tiny reversal bar gets you in at 12 or 11 and gives you the opportunity for the short trade. All right. In this scenario, the market trades to the upside and we pull back to support and we pull back to multiple time frame support. But what I really want you to see here is that they really tested the last of the synthetic triggers from the bottom side. All right, so you may not get a long trade there. Some traders will take a long trade there, but this trade becomes much easier when the small triggers make a strong breakout above this area and we pull right back to our Fibonacci support. And I remember this one because I actually did this trade. There was a teeny tiny little reversal bar here that had you long at 81 with about a 4-tick stop. Very, very good look after testing the triggers, testing the fibs, a strong breakout, a quick retracement back to this area. And I remember this area. There was not one green dot in all this area. So it's not the mid band. It's not here. This is the spot. When we hit our fib, you get the tiny reversal bar and high volume right at the fib. Easy long trade. Same thing here. All three trigger lines break through support. Pretty easy read that we're going to be going short. And, this is the spot where, if you get the tiny reversal bar from the mid band, great. If not, somewhere in here, you're looking for a high volume area short to take you down to the next support. One more instance, right? And then we talk about this in our educational room a lot. The location of our synthetic triggers well below resistance. And I want you to see kind of the progression, right? We make a pretty aggressive run up into this area, right? If you don't get short up here, that's okay. Allow the market to come down a little bit. Look for the pullback. During the pullback, recognize the fact that your small triggers are down considerably. And if you've got a high volume area somewhere in your Fibonacci here, sometimes it's even closer to the top, take that as your trade setup. Right? If you miss it and you get a high volume area over here, you can take this as a trade setup with the small triggers going down strong. All right. Again, as you're stopping out a pivot and retesting the top of those last synthetic triggers, all right, we talked about some of the more experienced traders will look for long trades in this situation with the small triggers rolling up. When you add your high volume area to this look, right, synthetic triggers crossed up above support, testing the last retest of your trouble spot and a pivot stop run, this is a look where you can start to take your first long trades, right? And then retesting of a prior area, then they stop everybody out. But again, all of your trigger lines are suggesting that we're going higher. Right? So you see the pivot stop run, you see the up bar, and then you look for a high volume area, pull back into your small triggers for the rest of the long trade. All right, again, same thing, strong small triggers into the area, right? We're looking for support to hold because all of our triggers are well above it. You can't do it right away. Remember that slide that I use really for the last year every day in our room? Now, once our small triggers roll up and they're helping the support area and we have a high volume area for an entry, we can take an entry here. And then you'll see when the small triggers have this look, this is our what we call a stab back trade, right? But it's really just strong small triggers very wide up. When you get this pullback into your area, guess what it's going to be? It's going to be a HVA. And you're going to be going long right here, and it's going to take off on you really quickly. And you're going to love that high volume area right there with this strong small trigger line look to the upside. And again, I've got so many of these examples, but I think you get the point at this point, right? Fibonacci support, you're not sure if it's going to hold. Small triggers roll up. High volume area here. If you didn't get it, again, very wide small triggers to the upside. Second chance opportunity at a high volume area retest for the rest of the trade up. And then overwhelming amounts of Fibonacci resistance up here, right? It's really strong into it, so you're not going to be getting short right here probably, right? So even if the high volume area comes down to 48.74, let's just say, the high volume area and this bar down was right here. You can still get in right there at the fibs with your small triggers down. So sometimes you don't always get the top or bottom. And this is where that high volume area is going to really help you define where to get into these trades. Then you'll recognize as we trade down to Fibonacci support, right? Support's anticipated to hold because none of your trigger lines broke. And when your small triggers roll up and you've got a high volume area right there, you're going to be able to take that long trade to get back up to the upside. Again, this is another example, and now we're starting to be a little bit redundant here, but it never hurts to see a bunch of examples. All three of your trigger lines broke through Fibonacci resistance. Look for your prior high volume area to help you fine tune where you're supposed to get in on that breakout. Right? Then we have an example of very compressed trigger lines with a close below. Right? If you get a real quick high volume pullback on your smaller bars at 90, you can go short. If it's at 90 and it takes off really quickly, as you come back to retest that high volume area with all your trigger lines below, you're going to be able to be much more confident that you're going to be able to sell 88 or 89 or wherever the high volume area is to get this short trade. So again, this one is compressed triggers, strong push down to support, retest of your high volume area with your small triggers below all your synthetic triggers, looking for short trades. We'll take another one, right? And again, you'll see this sometimes in a strong trending up market. Your market will come down and just stop at a fib, right? You may not be able to get in at that fib. After the reversal bar up, if your high volume area is inside of that reversal bar, that's how you're going to be able to take advantage of this look, knowing it's going to the upside to resistance. Again, hit Fibonacci resistance. None of your trigger lines broke it, so it should hold. Right? You either get a tiny reversal bar or, more than most likely, you get a lot of volume on the way down. And this little tail that stabs back is probably right into a HVA, where you're going to get short right here. The market's going to really quickly go down, and you're going to end up risking 3 or 4 ticks to get down to support. When you get to support, right, triggers get through it. Maybe you take a little long loser there, but more than most likely you're looking at 165 EMAs and really a lot of fibs. Again, recognizing no triggers breaking through. This multiple fibs with a 165 EMA in a strong uptrending market, this is the look where your tiny reversal bars or quick high volume areas are going to get you a really, really nice long trade. And again, this trade becomes a little scarier because everybody who's new to the software says, well, there's a lot of triggers in my way. right? And the read is fibs with none of the trigger lines breaking through and probably some overwhelming volume coming off of that area. Again, kind of an easier read here, right? Strong push up of your small triggers, pulling back to your fib area, small triggers rolling up, right? If you're not in a position and you've got a high volume area here, make sure you get long. And we'll do one more, and then I think, then it's a matter of going back and kind of studying through the charts and seeing this for yourself. But again, pretty easy read with strong triggers below, large gap as we get back to resistance with the anticipation of more continuation to the downside. This is the area where high volume right at the fib and a tiny reversal bar get you into a very low risk, high reward short trade. So again, I appreciate everybody's time. I know this is a little bit of a lengthy video, but I wanted to really cover all of the different looks and the different rules that you can go through. And I really want you guys to go back and study through those 11 rules. All right, when we look through these 11 rules, they're going to make a lot more sense to you now. Small triggers position relative to both of your synthetic triggers. So when you touch a Fibonacci, if your small triggers are above all of your synthetic triggers, longs will be easier. When your small triggers are below all of your synthetic triggers and you touch resistance, shorts are going to be easier. Now, your synthetic triggers, the location of them and which direction they're crossed in is key. If they're both crossed down or they're both well below your Fibonacci resistance area, shorts are going to be easier for you. If they're both crossed up and well above your Fibonacci area or a big gap, then longs are going to be easier. Rule number 3 is really key. A lot of people make this mistake. Never trade into a Fibonacci support or resistance area that caused a reversal if your trigger lines haven't broken that fib. Right? It's a target that got hit, and when the triggers don't break the fib area, you can't trade into it until you actually do break it. Only when you've got wide synthetic triggers and your small triggers have already broken it significantly can you trade that area anticipating it will break. Right? Number 4, if the small triggers are in between two synthetic triggers without much distance between them, the market typically gets choppy. You need to wait for a breakout before you're trading. Number 5, if the small and synthetic triggers make a very strong push into the area, we want to wait for confirmation. Right? Reversal bars, high volume areas that the area is actually going to turn before placing a trade. If the trigger lines break through a Fibonacci area and don't break back below or above, that area is likely to break. If there's a very large gap between price and your small triggers and your synthetic triggers, we've seen enough examples that the market generally will work to close that gap, especially if the small triggers cross back in the gap direction. Number 8, if the small triggers are very strong into an area you wish to trade, right, or the small triggers break beyond synthetic triggers, wait for confirmation, right? Reversal bars, high volume area, confirmation that that area is actually going to hold. Now, pullback entries, when the small triggers are very wide and crossed in your direction, have a high probability of working, especially when you have a high volume area helping you with wide, small triggers crossed in your direction. And remember this one, we've seen enough examples in number 10. At double tops or double bottoms, monitor your small trigger positioning and watch for potential reversals, right, when your triggers aren't making the same highs or lows. We call it trigger line divergence. Usually this happens at the same time you get divergence on your fib to fib oscillator. And this one's more management. If you're in a trade, short, let's say, and your small triggers are below both sets of your synthetic triggers, don't move your stops too fast. Be patient, wait for large tails, new pivots, new high volume bars before you actually trail your stops. Same thing if you were long. If your small triggers were above both sets of your synthetic triggers, relax. Allow the market to work its way back and forth and don't pull your stop up too fast so you don't get bumped out of a trade that has a strong look. If you incorporate these simple reads into your Fibonacci and trigger line reading, recognizing where the high probability setups is going to become very easy for you. I appreciate your time and look for the next video.